Yesterday was, euphoric. Now what? Well, yeah. First of all, Scott, thank you for having me on. Election night was historic, and I really, enjoyed it. The move yesterday, 3%, the best move in the history of any post-election rally, I think, needs to be respected because it really highlights one of two things or both. One is that there was so much de-risking going into that election. Actually, it was unusual. We fell for 2 weeks into election day. That happens about a third of the time. And the second is that animal spirits could be unleashed because of the interest and belief that there's deregulation, mergers, and a pro-business environment. So I think it's a very respectable move, and I think it sort of argues we have 5 to 10% upside into year-end. At what point, though, do you get on board with Barry Bannister's idea that the train could be leaving the station, heading up, full speed to crazy town? Well, he's sort of structurally correct that, this market top is not going to be because someone's going to have a problem with PE, or because a recession's going to happen. I believe it's very likely, in the next 6 months, the peak is because either firepower is spent or expectations have been unhinged. On markets, we can measure either, right? We can look at margin debt. That's just been flat for the last 4 months. So the market's been up, and most investors have been de-risking. That's that's fuel for me. Upside fuel. And when you look at sentiment readings, it's not extreme. In fact, the VX was excessive and just normalized yesterday. So I don't think sentiment is severe. Oh, just a quick question on the VX. It's funny you went there. I'm staring right at it. I mean, it's down 30% on the week. Just a full-blown collapse, right? Don't forget, we were above 20. I think we were at 22 at one point last week. We're barely above 15. Yes, examining the VX futures curve was genuinely rather fascinating. Up until August of the following year, the VX futures curve was above 20 on election day. It need to be approximately 15 or 16. The markets were pricing in turbulence and uncertainty for like 9 months, 10 months. So I think there's a huge amount of re-risking taking place. I don't think people got their exposure yesterday and today. I mean, look, I know, thought that we wouldn't know the outcome of the election for many weeks. I believe that was your initial situation. So I believe there's a lot of surprise rethink when we look at where this market might be able to go. Having said that, I would want to discuss your new ETF. It's called the FundStrat Granny Shots US Large Cap ETF. Granny Shots, since you believe they would be somewhat simpler to make, don't you? Yes, exactly. It's the way you construct it. We're talking about names. I hope we illustrate this. I suppose we produced this up. Tesla, Goldman, JPM, Johnson Controls, Caterpillar, Emerson, Transdium, Eaton, Oracle, Ingersoll, that's the top 10. But how you build that? The Granny Shots ETF is basically developed off the research model we utilize at FundStrat. That was a themed core stock portfolio that we have been employing since 2019, so for 6 consecutive years. It takes 7 what we consider relevant market themes, and it finds the most correlated stocks to those themes, whether it's AI, millennials, Fed easing, or improving PMIs. And then the stocks that emerge most frequently across themes are our Granny Shots. Granny Shots takes its moniker from the style of free throw shooting used by Hall of Famer Rick Barry. A few of us do recall that. Of course we do. With a weighted of 3.25%, Tesla is the top stock. Would you mind simply discussing this week's move in that stock, what it means to you, how you've constructed this, and where you believe it can go? Indeed, since its founding in 2019, Tesla has been featured in our study product. This is due to the company's secret asset, which is its intellectual property and artificial intelligence. Naturally, they also own the intellectual property that was developed around all of this infrastructure. Because people view it as an automaker and consider its present margins and earnings, that appears inexpensive to us. However, as is well known, there are numerous new projects, including robotaxi and, robots. Naturally, there is now a political component that you all thoroughly explored tonight. It can only benefit Tesla, in my opinion. Hey Tom, stay healthy. We'll speak with you shortly. Thank you. It's FundStrat's Tom Lee. But first, let's get started on this historic rally. Joining me now is Fundstrat Global Advisors Head of Research and a CNBC contributor, Tom Lee. Tom, it's nice to have you on. 1,500 points for the Dow today. We haven't seen a move like that in a couple of years. From here, where do we go? Whoa! In my opinion, Morgan, today serves as a clear illustration of how the market failed to factor in the outcome of an election. We would be trading flat if it did. I believe there is solid evidence that many investors de-risked before an election because they anticipated significant social turmoil, etc., and we could discuss this with our clients. Therefore, I believe that money is being used, but in a way that shows that there are a lot of animal spirits in the sectors that people are selecting. I should mention that Qualcomm's results have been released. We're reviewing those findings. We'll provide them to you shortly. We now have Mike Santoli as well. I'll give you my opinion on this one, Mike, and that is that we have witnessed the Trump trade in action today. This includes the dollar's appreciation versus other currencies, as well as the general decline in stocks, particularly those of banks, steel companies, and anything else that is thought to be more cyclical and economically susceptible to greater growth and deregulation. Bitcoin higher as well. But we've also witnessed significant sell-offs within this market under the hood too. There had been a lot of discussion on whether the so-called Trump trade, as it was being framed coming into today, was going to actually pan out and play out. What do you think? Well, it's definitely happening, and it makes sense, at least as a first effort. And I believe that on the majority of those fronts, it has primarily been a further push behind some of the tendencies that have been simmering beneath the surface. Once more, cyclical leadership has been in place for a short time. The dollar has been comparatively stable lately. Since the Fed lowered interest rates, yields have been rising, and the economy has shown encouraging surprises. When it comes to things like small caps moving, it's just a matter of sort of putting that 2016 playbook to use and perhaps honing it a little. Banks are obviously just hoarding the profits. I do believe that the subject of where to begin will come up. As far as valuation, inflation, deficits, recent economic growth rates, and perhaps even investor sentiment are concerned, the starting position is significantly different now than it was in 2016. Before the 2016 election, the market was flat for 18 months, but in the subsequent 18 months, we've seen a 40% increase. Animal spirits haven't been sleeping, in my opinion. Rather, this possible policy mix has effectively given them even more energy. Jim, in relation to excellent foundational businesses, what about technology? We reached these all-time highs because of those names after all. Will they carry us there any longer? Tomorrow, Nvidia will be released. All right, so let's discuss Nvidia. I want to offer a hat tip to Josh, who's, the one, I guess, of all of us, who's been in it the longest. Maybe you too, Jason. But look, the report is likely to be extremely good tomorrow. There's no reason to assume it will be differently. People can't get enough of the chips when you look at what the hyperscalers are talking about, which includes CapEx and almost every news story. I would advise against paying much attention to the short-term price activity. Much of this is related to short-dated options, which people are wearing to play the pop, most likely following earnings, and then selling the calls, which causes the stock to decline. Therefore, don't worry about the immediate action. Regarding technology in general, I believe that people will be reluctant to sell things as the year draws to a close for the same reasons that we have all discussed earlier in the show. Once more, you don't want to accept a taxable gain, and if you're benchmarked or indexed, you don't want to risk lagging behind the benchmark. I just wanted to connect this to what Josh was saying a moment ago, which is that the opposite of what I just stated is true when you discuss bottom fishing and why it's a terrible idea at the moment. The items that have been severely damaged this year are probably candidates for tax loss. In December, they will probably get bare mauled.